Are U.S. homes too expensive in 2025? It's a question on the minds of millions, as the dream of homeownership feels more distant than ever for many Americans. As fall arrives, millions of Americans are asking, has the housing market finally become too expensive for the average family, or is there still hope for buyers? For 3 years, buyers have watched prices and mortgage rates soar to record highs, making homeownership feel impossible for many. The cost of borrowing has doubled, and home prices have outpaced wage growth. Even as the market shows signs of cooling in some areas, affordability remains a huge challenge. Many families are forced to make tough decisions about their finances and future. The conversation has shifted from finding the perfect home to simply being able to afford one. Buyers are compromising on size, location, and amenities just to get a foot in the door. Many wonder, should they buy now and risk overpaying, or wait and risk even higher costs or missing out altogether? The uncertainty is stressful for everyone involved. Housing affordability is over 70% worse than before the pandemic, forcing families to spend much more of their income on housing. For some, renting is the only option, even as rents climb. The market is a patchwork. Some regions are cooling, others remain tight. Local trends can make a huge difference in what buyers experience. To understand if homes are truly overpriced, we must look at prices, mortgage rates, and local trends. Each factor plays a role in shaping the market. By piecing together these factors, we can see the real challenges and opportunities ahead for American homebuyers. The path to homeownership may be tough, but understanding the market is the first step toward making smart decisions. To understand 2025's market, we have to look back at the pandemic housing boom. Starting in 2020, low mortgage rates and remote work sent prices skyrocketing, up nearly 50% in 5 years. A $300,000 home in 2019 could now be worth $450,000. This surge created wealth for homeowners but locked out first-time buyers, as price growth far outpaced wages. Even as rates rose, sellers clung to high expectations, keeping prices elevated. The legacy of the pandemic boom is a market where affordability is stretched to the breaking point, and buyers are still competing with the shadow of those historic price jumps. Most experts agree, U.S. homes remain significantly overpriced for the average American. This has been a growing concern for many families who are finding it increasingly difficult to afford a home in today's market. The national median price has plateaued at unaffordable levels, and even a drop in mortgage rates won't fix the gap without lower prices. Many potential buyers are left in a tough spot, unable to bridge the financial divide. Experts define overpriced by comparing home prices to incomes, and that ratio is at historic highs. This disparity has made it challenging for average earners to keep up with the rising costs of homeownership. The South and West, once the hottest markets, are now seeing price declines. Austin and San Francisco have dropped over 10% from their peaks. These regions are experiencing a significant market correction. Meanwhile, the Northeast and Midwest remain tight, with prices holding firm or rising. These areas continue to see strong demand, keeping prices stable or even pushing them higher. 33 of the 50 largest metros saw year-over-year price declines in July 2025. But the story is highly local. Each city has its own unique market dynamics influencing these changes. For buyers, affordability depends on where you live. Some markets are correcting, others are still out of reach. It's a mixed bag, with some areas becoming more accessible while others remain prohibitively expensive. The national market is fractured, and the path to fair pricing is different everywhere. Navigating this landscape requires understanding the specific conditions of each local market. Home prices are only half the story. Borrowing costs matter too. Mortgage rates peaked near 8% in late 2023, freezing the market. By mid-2025, they've dipped below 7%, with some lenders offering rates in the high 5% range. But even at these lower rates, monthly payments are much higher than just a few years ago. Lower rates have brought some buyers back, but affordability remains near historic lows. Experts warn rates alone can't fix the crisis. High prices plus elevated rates keep the gap wide. If rates fall too quickly, demand could surge and push prices up again. The only real solution is a slow, steady easing of both prices and rates, a process that will take years. For years, too many buyers chased too few homes, But in 2025, that's starting to change. Inventory is finally growing. Active listings are up nearly 25% from last year, especially in the South and West. Still, total homes for sale remain below pre-pandemic levels, and the recovery is uneven. The South and West offer more choices and negotiating power, while the Northeast and Midwest remain tight. High prices and rates have pushed many buyers to the sidelines, causing sales to drop and homes to linger longer on the market. In July 2025, homes sat for 58 days before selling, a week longer than last year. The market is shifting. Buyers have more time and leverage, especially in regions where inventory has rebounded. This new dynamic is giving buyers options that were unthinkable just a few years ago. The balance of power is shifting. Buyers are more cautious and sellers are adjusting. In June 2025, 15% of home sale contracts fell through, a record high, as buyers refuse to overpay. Sellers are cutting prices. Over 20% of listings saw reductions in July, especially in the South and West. In tighter markets like the Northeast, price cuts are less common. Some sellers are pulling homes off the market rather than accept lower offers. Delistings are up nearly 50% in some cities. Buyers now expect repairs, contingencies, and better deals. Sellers must price realistically and be ready to negotiate. The market is in transition, with both sides learning to compromise. Will high prices end in a crash or a slow correction? That's the question on everyone's mind as the housing market faces a turning point. Are we heading for a dramatic drop or something more measured? Most experts agree. Expect a gradual rebalancing, not a sudden 2008-style collapse. The fundamentals today are much stronger, and the market is adjusting in a more controlled way. Risky lending and oversupply aren't issues today. Banks are more cautious, and builders haven't flooded the market with new homes. Instead, we'll likely see a slow return to normal as prices and rates adjust. This means fewer dramatic swings, but a steady shift toward balance. The South and West, where prices soared the most, may see further declines or flat prices for a while as demand cools. Meanwhile, the Midwest and Northeast will likely hold steady or even rise slightly, thanks to more stable local economies and less dramatic price growth. Nationally, prices are expected to stay flat or dip slightly, unless a major recession hits, which could change the outlook. Real affordability will require more than just lower prices. We'll need stable prices, lower interest rates, and wage growth to help buyers truly catch up. The U.S. homeowner population has stopped growing, as young people delay buying due to high costs, economic uncertainty, and tighter lending standards. The path to a balanced market will be slow. Buyers and sellers must focus on their local conditions, personal finances, and long-term goals, not just headlines. The journey back to affordable homeownership is a marathon, not a sprint. Patience, planning, and adaptability will be key for anyone hoping to buy or sell in the years ahead.